Hi guys.
Hey guys, welcome back. We have another. This was going to be a one-on-one bags cast with Cookie, but we've got the whole triumvirate here with GP and Nick's here with us. But we're very thankful to have some of Cookie's time. Um, anyway, I think it might be something good for us to get into. Just we have these couple minute talks before we go live, and we were talking about it's not the end of the world, and you watch the news and it's doom and gloom, and I don't think any of us necessarily see it that way. But Cookie, you were enlightening us a little bit with some of your perspective, and I was just hoping you could share.
Sure, and thanks for having me on the call again. It's good to be with you all, and it's good to be with Nick and GP again as well. So just with regards to what's going on right now, I think there is so much doom and gloom out there, and I think for those of us who actively trade or invest, it's hard to find anything which is other than just negativity and the world is falling apart and so on. And I think it's more important than ever for us to at least balance the discourse, to offer maybe a different point of view. It doesn't necessarily mean that we think the market is bullish, but to offer some insights which might help those who are struggling a little bit, maybe finding it very tough going. I mean, the last 2 or 3 months have been probably amongst the hardest in the last 2 or 3 years, I'd say, right? Or since COVID. So I wanted to offer some time to help anybody out there who maybe was looking for, maybe the other side of the discussion. So that's why I'm here today.
Glad to have you.
And we definitely appreciate it. The market's having a nice little rally right now, and in bear rallies, you can expect some volatility. But overall, nothing has changed. We're still waiting on the FOMC tomorrow. They're actually meeting today and tomorrow, with Jay Powell speaking tomorrow. But Cookie, just wondering, we got a question yesterday. How do you look at how the FOMC might change your thesis, might change your charting, etc.?
Okay. Well, I mean, to begin with, I'm a pure technical trader, right? So I have my chart set up and I've got my support and resistance levels. I look at the trends based on the moving averages. And then everything else, whether it's the FOMC or whether it's news out of Russia and Ukraine or the EU, or it could be anything, right? Is basically just how price moves around, how it gets pushed around based on some of those inputs, but reflected in the chart. So the short answer is, the catalysts like the FOMC could change the direction of price, but ultimately what I'm looking for is whether that changes any trends, right? So it's very straightforward for me, if I, without wanting to sound overly arrogant, but it's if what happens with the FOMC, what happens as a result of the FOMC pushes price in a certain direction, then I'll respect that. If it changes a trend, then I'll respect that. I won't fight what I see happening in the chart ever, right? So I'm not really sure whether that answers the question in the way that the person who asked it, but it's pretty straightforward for me. I'm not sure if that came across.
No, I think it does. I mean, you're not necessarily looking for, the FO. When you're a technical trader, these news events usually fall in line with your technical analysis, right? So it's not like one drives the other; it's one is part of the other, more or less.
Right. Exactly. Yeah. And if I may just say, we're clearly in bearish trends. The markets have been in a bearish trend for a couple of months now, and one of the things that we look for, one of the things I look for as a technical trader is signals for reversals. And typically, what you get those at weekly or monthly pivots, or you see failed breakdowns, which could then lead to a reversal in trend. So that would be a more concrete example of the type of thing I might be looking for this week as a result of the Fed. So let's say, for example, QQQ or ES is below a weekly support. Then as a result of what Jay Powell says and does that see price regain a lost support? If it does, then clearly it's a lot more meaningful than if price just continues heading in the same direction before the meeting. So, so I'll be looking out for things like that on short time frames. So, do we regain a bullish trend on a 4-hour chart, for example, which is a time frame I use quite a lot, and then does that help to regain trends on a daily or a weekly chart? So, so very concrete, actually. I mean, I'll be looking for things like that this week. And we can talk about the likelihood of that. We can talk about the Fed, what might happen this week. I think a lot has happened in the world over the last couple of months that maybe the Fed wasn't contemplating 3 months ago, namely what's happening in Russia and the Ukraine, and whether that will have an impact into what they do over the next 3 to 6 months remains to be seen. But certainly I think that there's an expectation that the Fed may not be as hawkish as maybe they were planning to be at the beginning of the year. And so that could lead to changes in the charts. So we're very open to that possibility this week.
GP, Nick, if you guys have anything, you can jump in at any time. So I don't, want to just dominate.
I think you guys know where I'm going with this. I'm in the same boat that he's in. Like from a technical perspective, the news, the FOMC announcement plays very little role in my decision making. I have things that I'm looking for that will give me clues as to whether or not the trend is changing. We talked about that earlier, like, just if you pull up a chart of the Qs, you can just say like, okay, I want price to rally here. I want it to hold and then continue higher. I don't know. I'm in the same camp. I feel you.
Right.
Yeah, I'm probably a slightly different camp. I think more of a bigger statement is like, I think this week is the week 17 since we hit all-time highs on the NQs. We're coming into big support. The FOMC, I think everyone's already expecting a 50 basis point hike. If we get anything lower or around the same thing, I think it's a conversation of removing certainty from the markets. So you tend to see better price action after that. So I think in general, I don't do a lot of FOMC stuff because I do options trading and premiums are high and going into that. So a lot of it gets pulled out immediately. So once we get a trend afterwards, you'll be able to play it a lot easier. So it factors into my trading because it limits me from trading a lot. I'll try some small positions here and there, but I don't put any kind of real money towards any trades, especially short-term trades, until some of that volatility gets pulled out, the premiums.
If I could add just one, slightly different point of view, not a different point of view, but an additional piece of information that I'm looking at. If you recall 2 or 3 months ago, when we looked at the possibility of the market correcting around this time, excuse me, based on a Fed tightening cycle, and I think it was a call that we had, Bags, was it a month ago, 2 months ago, where we went through how that might work out. Now, one of the exercises the one type of exercise that I do frequently with the group that I have is look at scenarios which are, first off, we trade the trend, right? So the trend is what it is. If it's bearish, then, we have we lean bearish. We're not going to fight the trends in the charts. But at the same time, one of the exercises that I do is try and forecast the trends, right? So, and what that means is there's 2 ways we can do that. One is to look at a similar set of circumstances historically and say whether, how price moved given a similar set maybe 2 or 3 years ago. That's one thing. And another way, which is slightly more objective and a little bit more technical, is look at fractals in price. And an exercise, and the reason I'm mentioning this is just as recently as last weekend, we went through an exercise which involved looking at, and I mentioned Q4 2018, and I think many people have looked at that as a potential roadmap or blueprint to what might happen in the market. But what we looked at recently was what if Q4 2018 isn't a fractal, isn't a complete fractal, but it's part of a larger fractal, meaning from 2000, from the beginning of 2018 through to the middle of 2019, in which Q4 2018 was a very rough patch. And the reason I'm saying this is because what we're seeing in the market now in Q1 2022 is also part of a fractal which began 3 or 4 months ago. And maybe later, because it might be hard for people to visualize what I'm trying to say. Maybe later during the call I can actually pull up the chart. But
sure.
It's possible to show. Oh, okay. Now you want to share the screen.
Yeah, go for it.
It's possible to actually try and do that. So let me see. Okay, so let me share my desktop. Hold on.
It was almost 2 months, 7+ weeks ago that we talked about how this might play out, Cookie. So if anybody's new to the channel, go back and watch that from January 25th. I think it might enlighten some of the discussion that we've had today, or that we're going to have today.
Okay. So, to try and recreate this live on the call, it might take a few minutes, and I don't want to bore your listeners, but I can certainly have a go. Maybe we can have a a discussion with the rest of the group whilst I'm doing this. But certainly, I think what's interesting is, and this building up upon what GP said, is this area of support that we're seeing in the market isn't just a technical level of support, but it also happens to be a key cornerstone of this fractal idea that I just touched upon. It's actually pretty amazing to see. So I think now that I've said that, you want to see it.
Yeah.
So let me see if I can try and get that up. I think it was on the weekly time frame that I did it.
While you do that, we can chat about the destruction in oil and gold if we want to, Nick.
Yeah, totally.
Are you still long, or are you now out of both those positions, or at least the gold position?
I still have the ETFs, so GLD and SLV, and the last of the miners that I have on is the AUY.
Okay.
I initially tried to play the bounce this morning, and I caught a little bit of it. I don't know. I was expecting a lot of 20-day tests and a lot of those miners, and that's kind of where I was looking to kind of get back involved. I kind of mentioned that in FNV and NEM. I just didn't execute the way that I should have. So I don't have a lot of them on currently.
Yeah,
GLD is kind
which
of,
I think is okay, right?
The week, yeah, totally.
Yeah, isn't like the market's just been a bit nutty in terms of like the price action, like the VIX, the VXX today, because Barclays announced their garbage. I don't understand that whole conversation, but yeah, it's just a bit wonky in terms of it makes sense to wait for direction now, right?
Yeah, I mean, unless you have like if there's a very clear setup and there's some type of news announcement, I may not really care if the news announcement's coming, but there's not really a setup there for me to play. And so it's like, I don't need to be getting into a new position where I have no cushion before a pretty, a news announcement that a lot of people are kind of paying attention to.
You're going to start adding in those standard deviation bands?
Yeah.
Like it's so like maybe not on the daily and weekly, but when it hits it on the monthly, that's usually clear cut resistance.
Yeah. Looking at the GLD, God, I really don't like the daily or the weekly right now, just being, it kind of looks like almost like what is it called? Like a shooting star or an island top.
Yeah.
On whatever day that was, we gapped up and tapped, and then we close at the low end of that range on the weekly. So like the only saving grace here is like looking at the monthly, and you're like, okay, we got a couple weeks left in the month. This is a really ugly candle right now. We need a monthly close like above, I don't know, 185, 188-ish to even look good. Otherwise, it just looks like a complete double top and a complete failure in price, breaking out. At the same time, like on the weekly time frame, price is right where I want to see it hold. I mean, this is kind of the level we were talking about, that 178, 180 area. The 10-week line is starting to curl or catch up the price. So it's sitting there at like 175. I think as long as it holds here, you know, I think you and I are kind of in agreement in what's to come kind of the next, you know, few weeks to few months. So
prior month's close is 178. Prior month high is 182. So that's the levels we were kind of referring to. A slow trickle down here, not a bigger move. It's what we talked about on the Sunday call, which is stay in like a bullish range in the top 50% or whatever range. You're gonna have all the people who are fighting the decline in the stock market now fighting the decline in gold and oil, in my opinion. And they're gonna get worn out
with the ES.
Yeah.
Sorry, guys.
Oh, sorry.
Yeah, no,
please continue.
Whenever you're ready, Cookie, just interrupt us.
No, I'm happy to listen to what you guys are saying. It's okay. Go ahead. I mean, I could even share an oil and gold chart. If you want to see that, I've got. If you want to see my take on gold and oil, I'm happy to share that. But before I do, let me then just take you through very quickly through this, right? So this is the idea that we looked at 2 months ago, which was the pullback at the end of 2018. Now, what I looked at was, well, what if this was part of something bigger, which is a back test of this breakout? Okay, now it's very clear to see on this chart like that. So what I then wanted to do was to see whether we have something similar going on today. Now, let me just take this line over here, and you can see it's actually very, very close. So here what you end up with now is it doesn't match up exactly because I'm showing it on a linear scale, but on a log scale, it actually matches up exactly. I mean, these tips mark this. And the reason why I don't want to do it on the log is because it's a little bit more cumbersome how you translate a line in log scale, but I'm going to leave that for now. For now, just let's assume that it is. If you do on a log scale, you'll get this touching the same slope as what you had in 2018. So the same gradient of this line touches these lows on the log scale. And it's this breakout here. So what you're seeing now is not only a pullback, which has similar look in terms of moving averages and the trend as you had at the end of 2018, but you can see how it forms a back test of a previous breakout in October, just like it was early in 2018. So then what that starts you thinking about as well, not only is this area of support important, but it also potentially lines up with something which is far bigger that looked like this in 2018. So you end up finding additional pieces of information that help you, not necessarily to say that the market is going to race higher. Let me see if I can, I can't do this. That's something I think I tried last time on the call, is how can I draw? Maybe you need to allow me to do, hold on. I'm not sure how you can do that, Dags, but if I'm able to draw on the screen, otherwise I'll just do what I did last time, right? But for now, the options are, if we hold this support, do we get a move higher like we did at the end of 2018 and early 2019? Now, the way I use fractals to try and describe what might happen in prices is not to predict that this necessarily must go high, but it tells me that this is an inflection point. And I think this is the point that GP made earlier as well. Not necessarily calling this a bottom, but if the market was to bottom, then this would be a fantastic place for that to happen. And that's already worth gold. If you're trading, then that's what you want to look for. You want to look for areas which are higher probability reversal areas or turning points that allow you to then set up trades. And if it doesn't work out, you just get out. Trend is bearish. If it doesn't work, then you just close it. You take your chips off the table and you move away and you look for some other. You just let the trend play out. But certainly, as far as ES, QQQ, and many charts are concerned, I think I shared a couple on StockFit's earlier snips of charts from ARC to QQQ and ES. This is a great place for a bottom. So now what you have is let me just add something on this chart as well. And whilst I'm doing that, feel free to ask questions. I'm happy for this to be a dialogue and not a monologue, right? Moving averages. Let me just put a couple of these down. The way I look at trend is very simply just through the moving averages. And you hear me talking about that a lot on StockFit sometimes as well. So I'll put my 9-weekly moving average in red. I'll try and be consistent just so it's in red. Just so that's easier.
Simple or exponential?
Simple is fine. And then let me just get the 20 up as well. Put this one in blue.
That's an inside joke between Cookie and I.
Yeah. Did I almost throw you off for that? I'm not sure if it was maybe.
Well, it was because I added you. I hit the add.
Yeah, that's right. So anyway, coming back to this, right? So so here you've got, for me, this is a bearish trend simply because the 9-weekly moving average is falling, right? So if the moving average is falling, it's a bearish trend. If it's rising, it's a bullish trend. So whilst that might coincide with higher highs and higher lows and lower highs and lower lows, it's just far easier, simpler, just to look at the slope of the moving average and just say it's a bearish trend. It saves me from having to look for a shit ton of information to try and support that decision. It's just very simple, right? So if we have a bearish trend, so what I'm looking for here are clues to a reversal of this bearish trend given this area of support. And what that means is I need price to hold this support for long enough that eventually takes out the 9-weekly moving average, and that weekly moving average turns. It starts pointing higher, just like it did over here, right? So I mean, if the price bounces, doesn't create, so there's 3 weeks here before it finally actually takes a moving average back. But it doesn't, I mean, even if you miss this, it doesn't matter, right? I mean, it doesn't make any, well, you could find the bullish trend on a shorter time frame first. I mean, I'm looking at a weekly chart, but you'd see it show up on the 4-hour chart before the weekly anyway. But for now, I've been looking for something like this over the coming days and weeks, where the price, first of all, is able to hold this area of support for long enough that when the 9MA comes down, we get above it. And then we hold it, and then we see whatever consolidation takes place, but the beginning of a potential uptrend. And this is the idea, and this combines with this idea of the fractal that I mentioned earlier, right? So it's not just this area here, right? Let me just, sorry, let me just get this down, right? So it's not just the downtrend here, right? So that's the downtrend that we had in Q4 2018. This is the downtrend. Let me just try something which I haven't done yet. Not that, sorry about that. Let me copy this. So I'm just going to clone that and just move it down here, and by magic you'll see, oh, look at that, what a coincidence. Right now, what's interesting here, and this is an exercise that we could go into a little bit of detail in as well during the call, is how I do trend lines and how I do channels. But notice that, so there was no Russia here, right? There's no Russia-Ukraine crisis. There was the China-US trade war, right? Which I also talked about during the call over the weekend, right? So you have the China-US trade war over here. You have prices cratering over there, and then hold on, what's this? And then
similar, Cookie, right? Like in terms of like kind of the conversation. One day the China trade war was on, one day it's off, one day it's on, one day it's off. And we have the Ukraine. There's peace talks. There's no peace talks. So there are some similarities from that conversation as well.
There are two big factors affecting price today, right? So one is, this is ignoring valuations and all the rest of it, right? But just geopolitics and what's going on with monetary policy. So you've got China-US trade war over here. You've got Russia-US. You've got Russia-Ukraine, and you've got also the economic impact of Russia invading Ukraine. So I mean, let's not forget, McDonald's is pulling out, Goldman Sachs is pulling out. All these big multinationals are pulling out of Russia. So certainly from an economic point of view, you could argue that if China-US had an impact in the market, then certainly the large Western multinationals pulling out of Russia was also going to have some sort of an impact on the economy as well. One could argue that, right? But what's interesting is that these shapes are the same. I mean, I copied this. Right? So then you start saying, well, how random is the market? Well, clearly it's not. I mean, what I call this is the volatility in the trend. So when I draw channels like this, what I'm trying to show is not only the move down, but how volatile is the move down. So that the height or the depth of this channel gives me an idea of the volatility that's in the trend. And you can see it's identical, right? So you can see it's I copied the same thing. So not only do we, we could argue how, the timing of the Fed and whether it's a month or two out compared to 2018 and whether it already started tightening, because I know GP, you think that, right? But irrespective of that, you can see how these areas in the chart are identical. Now, one of the statements I made the other day is, clearly we can't forecast the future with 100% certainty. We can't do that. But certainly if the beginning of the fractal is identical, then certainly it's not a bad assumption to say, well, the remainder of the fractal could continue in the same way. I mean, it might not do that, but certainly it's not a bad starting point for the discussion. So it starts off in the same way, and then either, we'll get two pieces of information, either it does, and then I know what could happen next, right? Roughly, right? So I mean, clearly it's going to be slightly different. And one of the, then I did all sorts of other things over the weekend as well, but I'm just going to do that for the time being, draw it like that and say, well, let's draw it like this. And then say, well, this gives me an idea of what the market may do in the future. And you can see how these things do not, and again, this is on a linear scale and not log, but you'll be surprised at how close these are. And the point I wanted to just to raise with you and with the group who's listening as well is, it's no longer now just 2018. It's no longer just Q4 2018, but it's what preceded that. So this whole period began. It didn't begin in December. It began in October or even late summer, when the market pushed higher. Was this area over here, right? So it pushes higher over here, and then it pulls back. So anyway, long story short, is if the market does bottom here, and if it does, it's likely to be because of a catalyst that forces this trend change. And it's not really naturally just going to happen. We may find technical support based on levels, Fibonacci's, and all the rest of it. But for the trend to change, it requires more than just a technical support. For the trend to change, then there must be a catalyst out there that I think would affect that. And there's, well, you look around and where is it? Well, we've got the Fed meeting this week. Well, how perfect is that? Right? Clearly, it's just perfect.
That's a cookie, right? I think the chart helps. When I was taught this, is like charts can usually predict news that's going to come, right, or catalysts and stuff like that. So it goes in line with that, as well as like you're coming into support and doing all that stuff. You're potentially going to see a catalyst that you're not going to expect for the upside or downside, right? Either way.
Correct. And here, let me be clear as well. I'm not stating that we will necessarily go higher. What I'm saying is this is as good a spot as any for us to do so. And there's a catalyst to enable that.
Sorry to interrupt you. I think it's important to also for people that are listening to recognize here that what we're talking about is edge. Like you have a theory or whatever it is, and you're stacking the different odds in your favor, but ultimately you're letting price dictate your behavior, your decision, right? You understand what I'm saying?
100%.
Right. Okay.
And that's
just so people it's like this is giving us the ability to giving us a reason to enter versus just saying oh, I don't know, just throw a dart at the board and I'm gonna buy it here.
Right. Yeah, when I first started, I would have been that guy buying Roku at 350 or 400 and then watch it go to 100 or whatever it is, right? I think that's what gave me back my edge, which is having the ability to find a spot that makes sense on a chart to enter versus just entering because you like the company or it's going up or whatever most new investors kind of start with. I think even on a really simplified point of view, Cookie, if it's just holding the 20-month moving average, a moving average that has held the XPX for the most part since just looking back, I have the monthly chart open and it goes back to the 80s, right? Except for two major things, and that was the dot-com crisis and the financial crisis in 2008. Other than that, the trend has been every so often we get a test to the 20-month moving average. We push down slightly below that and we reverse the next month.
Correct.
Right. So even if you're looking at simplified terms, we're at a point where it makes sense on a lot of edges. And if that edge breaks down, then the trend is inherently worse. But calling for the end of the world and doing that stuff is where I struggle in moments of after a 23% move down into support. You need to see the evidence to confirm that it is the end of the world.
I mean, the question to ask is, has the market done this before and survived? right? I mean, have we been in this situation and have we survived? And if we have, then you can't draw the conclusion and say, well, we're necessarily going to break down and never come back from this. I mean, and which is what you're saying. And I think if you go back to even, this chart doesn't go that far back, but there are many occasions where the market's pulled back to the 20 monthly moving average and survived. And in fact, one of the things that we've been looking at as early as the summer of last year was, what would that look like in 2021, 2022, and moving forward? Because clearly, there was going to be a correction at some point, right? I mean, we can't continue to go like this forever. And these corrections are great because they allow us to retest the 20 monthly moving average, like you said, and it's not the end of the world. I mean, we see multiple times where that happens. Clearly, there are times when, and you can say, well, once the 9 MA crosses the 20 MA, then you get periods which are a little bit more prolonged, right? But and you can see that. And so again, this goes back to being very, very simple. So whilst we've got a rising 20 monthly moving average, the 9 MA could come closer and we could end up with periods of consolidation, not unlike this. Let me just draw this area over here. Not unlike that. I mean, one of the things that we could get something like this, right? Where you've got this period below the 20 MA and the moving averages come together, and it just opens up this period of a year where the market goes sideways, but it doesn't necessarily go down the gutter, right? And there's that, and it happens frequently. You see that over here as well. You see it many, many times. You see it there, you see it over here, where you've got a period before the 20 MA, the moving averages come together, and when they do come together, then either the market breaks down or it continues chugging higher. And most of the time, it chugs higher, right? I mean, you don't really want to factor in long tail risk as something that's common and going to happen every day. So for what we're looking for, what I'm thinking what could happen is, let's give the benefit of the doubt to the trend to begin with on the monthly time frame, which is, sure, we're getting this pullback, which, as I mentioned earlier, is very similar to what we've seen in 2018. But if that extends further such that the 9 MA crosses the 20 MA in the coming months, and it will take months for that to happen. I mean, when we talked last time, it was 3 months ago when Bags had me on the call, and it's taken that long to play out just to get to here. And I think one of the things that many market participants fail to understand is, even though we're seeing high, a great deal of volatility, the actual moves in the market take months to play out, many, many months. I mean, this took 2 years to play out. This took 2 years to play out. Right now, I think as traders, we should rejoice at the opportunities to be able to trade high volatility markets, keep our heads focused on what we're seeing in terms of long-term trends, but not jump the gun and claim we're going to necessarily see a 2020 correction or a bear market like 2008. It could well happen, but we're just not there yet.
I'm with you.
Yeah, Bags, do we have any more questions? In terms, I think there was a few, right?
Yeah, there were a couple. We kind of went over the expectation at FOMC, and we didn't really touch on the VIX much. But one of the questions was, the VIX can't be charted. That was the person's comment, and that might have come off of our conversation. What was it, last week, that Cookie, you were drawing a wedge on the VIX. I wonder if you just have a take to that, or how you would like to respond to the VIX can't be charted.
Well, I mean, the thing is that, what's curious is I could show the VIX being charted and giving very precise output, but those who believe the VIX can't be charted will continue to hold that belief.
Right? So true. Like anything.
Exactly, and I think that comes down to a lot of how people deal with the market. So let me just show VIX for stock twids, right? So this is the chart that I shared.
That was the most profound quote of this Zoom sesh so far.
Yeah, absolutely.
Right. So I mean, this is what I shared a week ago. And a week ago, I shared these two dates. I said the Fed rate announcement on the 16th, the VIX contract rollover on the 15th. We've got this rising wedge. And, the people who say you can't chart the VIX, well, why would the VIX pull back at resistance. If you can't chart the VIX, then it should pull back randomly. But if it pulls back at places that make sense and that you can forecast, then isn't that the definition of being able to chart it? And if I say, yes, I can forecast where it's going to find support and resistance, then that's certainly then for me, that's a definition of it's chartable. Now, let me just break that down into something far simpler as well, right? So we've been using the 20-day moving average as a guide to trend for the VIX. And what you see is time and time again, the VIX comes down and it finds support around that 20-day moving average, just as it did yesterday, and it bounced higher, and then today is doing the same thing. But what's interesting here is when I shared this chart a week ago and stuck to it, I had this pivot at 32.15 for this day, for the 15th, right, which is today. And you can see that's roughly where the VIX is. It's finding resistance over here, and it's finding support at the 20-day moving average. So, again, I would just go back and say, well, if you're able to see evidence that supports the fact or supports the idea that the VIX can be charted, then what's it going to take you to change your mind? And I would go back to the person who's asking the questions, or those out there who believe the VIX can't be charted, and say, well, maybe you should have an open mind and see that it can. I mean, and if I may just say as well that I spend a lot of time charting the VIX as well, and it's uncannily accurate. I mean, to the cent. I'm just sharing a chart on here for a simple output, but I'm not going to share my VIX charts, but it's amazing that Bags, you've seen them. I mean, you were with me for a while, right? Yep. I mean, to the cent, to within a couple of cents, weeks out. And I'm not saying I can forecast the VIX, but I can say where the VIX will find support and resistance, which is what charting is, and use that then to make my trading decisions. So yeah, I would say, yeah, you can chart it.
Along with that, we also had, and I think you kind of touched on this a little bit, Cookie, but maybe you can, and Nick and GP, you guys can obviously chime in a little bit, but what would it take for you to get bearish? And I think that's a really broad overall question, because I think we're all in the camp of the world is not ending and we're not going to zero. So by not going to zero, then I guess we're not bearish enough. But anyway.
Okay. I mean, I have a really simple way of answering that, right? Let me just get. So I want to put let's get the ES chart up again, for example, because I think it'll be easier if I just explain it doing that. Because I don't hold any bias. I mean, my bias is based on price. So it's not whether I'm bullish or bearish, it's whether price is bullish or bearish. And I think, many times, we attack people for being bullish or bearish, but it's their interpretation of price. Now, price is either bullish or bearish. There's no discussion. And it could only come down to time frame. So you could argue on a different time frame is bullish or bearish, but that doesn't depend on the user's bias. It is or it isn't. And so when people say, well, hold on a Cookie, you seem to be they don't really say this to me because I think they're frightened that I might shout at them, but but generally speaking, I am bullish if the moving averages are pointing up. I am bearish if the moving averages are pointing down, and that's it. So here, for example, right, this is just the daily chart. If the moving average is pointing south, it's a bearish trend. If it's pointing up, it's a bullish trend, and that's it. I will never deviate from that, ever. I mean, that's my foundation. And then on top of that, I'll look for pivots. So basically, my role is anybody. So once I've said that, then anybody can trade. I say, right, okay, well, if the trend is bearish, then so this is a choice, right? Because some people don't like to short. So either you just step away until the market turns and it becomes bullish again, or you take advantage of a bearish trend and you trade it. One of the phrases I use often is, don't wish for change, just wish for easy. And what I mean by that is, if there's an easy bearish trend, then trade with the easy bearish trend. Don't wish for it to change. So even though I am on the lookout for the potential trend change, I am not going to, ignore an easy bearish trend. Having said that, this trend hasn't actually been very easy. There's all that volatility in between, right? But the point being, if you've got a clear trend, then you should trade it. So I'm here, I'm bearish. I'm looking for clues for a reversal, but it doesn't stop me being bearish whilst the trend is bearish. All right, so absolutely, I have no bias there at all. And normally speaking, I will formulate my, sorry, I don't need to go there. I will look at weekly and monthly time frames, right? So here you've got the 9 monthly moving average. Are we bullish or bearish? Well, I would say we'd only started to look bearish only just in the last couple of months. And it's arguable whether that remains so, because if I put the 20 MA back up here, and we were talking about that just earlier, right? So you can say, well, once the 20 MA is still pointing higher, how bearish is it? And if you use the 20 MA as your guide to being bullish or bearish in the market, well, has the 20 MA ever rolled over? I mean, you could go back years, right? We were talking before about the 20 MA being hit, but it rarely rolls over. And when it does, then that's when you get a recession. I mean, let me just mention that. People talk about bear markets, right, with a 20% pullback. For me, I use a very different definition of a bear market. For me, a bear market is if the 20 MA rolls over on the monthly time frame. That for me is a bear market. Unless that happens, it's still a bull market. Right. And what that does is it stops me. I mean, it doesn't mean we will get periods of high volatility along the way, but it stops me from exiting the market. What it does instead is it helps me to look for the dips, even though they may be very severe, but it doesn't see me exit the market unless we get a period where the 20 MA rolls over. And when it does roll over, then I say, well, yeah, the market is bearish. So I'm using that very, very simple yardstick to determine whether I want to be in the market and whether I want to buy dips or not. And generally speaking, I think that's probably why many people out there may say, well, Cook is like almost always bullish. Well, isn't the chart almost always bullish? Right? Except for 2008. I mean, clearly we can see how we can take advantage of these periods over here using the different tools, the different time frames, using the different charts that we've got. But it doesn't make me bearish just because we've seen this volatility. This is volatility in a bull market. Now, I don't know whether the others think the same way, but for me, it's helped me remain focused and true to spending as much time in a market as possible and only exiting when we see something like that.
So for me, any test to a rising moving average is bullish, not bearish, right? And a test to a flat moving average is indifferent. And if you have the moving average, as you said, Cookie, pointing down, then obviously that's bearish. I think there's a lot for me in terms of bullish and bearish. We have talking about this since October or November. Price action has been garbage. It's just not making your highs. People are selling all that stuff, but it's all going into rising moving averages, right? So like if the slope of hope is what you're paying attention to, and the slope is up, are you like a master predictor that all of a sudden that you're saying that all that stuff is going to disappear because you say so and it's going to die? You need to see it first happen, right? Like if you break a rising moving average, daily, weekly, monthly, whatever time frame you're looking at, and it doesn't recover the next month or recovers the next month or week or day and then gets rejected, then that's what you got to pay attention to, right? Because then that means the trend has changed because it broke a rising moving average, but it has not reclaimed it. So the trend is different for me at that point. So there's a lot. It's hard to be. I'm bearish in certain, I'm bullish in certain, but when you start seeing these exponential moves happening at the late stage of cycles in, in gold and oil and stuff like that, it tells me that money hasn't moved out of the market. So in general, it's not that bearish, it's rotation. So it's rotation out of tech into commodities and metals. So people aren't saying the market is forsaken. They're saying we don't want to be in tech right now. We want to be somewhere else. So when that starts to also shift, this is not a chart view, but when you start seeing that too, when everything sells off, that's been my general definition of we should be watching for is like if you see everything sell off and like in most markets, when we get a 2008 type crisis, people aren't like, hey, let me hold on to my IBM because it pays dividend, or let me hold on to my Cisco because it pays a dividend. No, they're like, I need cash. The world's going to end. I might need to be in the breadline. Whatever you want to say, they're selling down risk assets across the board. There's no, maybe there's a handful of maybe one or two in each sector that outperform the rest of the market, but that's just been always my general view.
Let me share, a dirty little secret here as well. Most of the people who we come across, whether it's on StockTwits or on forums elsewhere, they don't really care about the long-term trend in the market. They just want to make money on a day-to-day basis. So
Yeah.
if that's the case, do they really care that the moving average on the monthly chart is pointing up or down? All they're looking for is how much money they can make on an options trade during the day or during the week.
But they should care, right?
Well,
right. Even on their shorter time frames, it's the same conversation. Even if you're doing a 1 minute chart.
You're right. But the point being that what's gonna decide whether they make money or not on that trade during the week isn't necessarily the 5 or 10 minute trade, but it's the level the VIX is at, or how difficult that market is going to be to trade. So I think over here the market is insanely bearish, but it's very, very difficult to trade. So just because it's very bearish, it doesn't mean they're going to make a lot of money on the short side. In fact, they're probably losing just as much money as the longs are. And it's because the market is tough to trade when the VIX is above 25. And I think there are two things here. One is how people trade and how people invest, right? I think we need to separate those two out. So if you're trading, then it doesn't really, if you're trading day to day on a short-term time basis, then it doesn't really make a whole lot of difference which way the market is going, as long as there are opportunities in volatility for you to be able to make that money. But if you are looking to invest in the market, then for those guys, perhaps it does make a little bit more difference to look at longer-term trends, whether on the weekly or the monthly timeframes. And one of the things that I mentioned on the call a month or so ago when I was last on was, for me, the objective isn't necessarily about being in the market or being out of the market, but it's about accumulating assets in the market. And if I'm able to do that, if I'm able to use trading as a tool to accumulate more shares, then that for me is the objective, or that for many of us is the objective. So even in a bearish trend, it doesn't necessarily mean that we exit the market. We just use that to accumulate an extra 20% in Tesla shares by either shorting it or whatever, and using those profits to accumulate more shares. So I think a lot of it also comes down to what each individual's objectives are. And I think for most of us, or for most of the people who may be either listening or on StockTwits, I think there's a great deal of short-termism. And while they might have a view on where they think the market might be 6 months from now, ultimately it's not going to make a whole lot of difference as to how much money they make. What's going to make a bigger difference is whether they're able to read, short-term trends and volatility on an intraday basis. And again, that's just a very throwaway statement, but I'm pretty sure that's the way it is.
Hey guys, we got about 20 more minutes or so, and I've got one more question that came in yesterday. But if you guys wouldn't mind to go ahead and share either the YouTube link, or you can retweet my message too, just to see if we can get a few more questions before we end the hour.
Yeah, I retweeted on Twitter already. I'll retweet it on StockTwits.
Or you can make your own. I put the link in the chat for us here. But Cookie, the last question I had before we get into hopefully some more of these new ones was if you could look at a firm. Somebody wanted you to chart a firm.
What's the ticker for that? Is it AFL?
AFRM.
Okay, let's take a look at that. Now, I hold calls where we look at.
Oh my gosh. I haven't looked at this.
Yeah, this is one of those high growth names that just absolutely got smacked.
Okay, right. So it's a very young stock, isn't it?
Yeah, and it looks like it's making lows now too.
Hold on, let me just auto. Let's do that. Okay, let's
stay away from all IPOs for the first 2 years if your name is not Google. Boom, that's your answer.
I'm sorry, whoever asked this, you didn't leave your name, so that might be a good thing for you, I guess, maybe.
Okay, now
you should think it's not
Cookie,
just a firm, though, right?
Sorry?
This is one of my challenges, Cookie, too, is how do you look at a young chart, right? And a firm's not the only one that has a similar pattern with very little history. But how do you go about, you know, providing TA for something with such a short time frame?
Okay, good. I think it's a great question, and I think it's good that we look at something like a firm as well, because I think there are many people who have bought into some of these SPACs, right, recently in the last year or two, which have absolutely gone down the toilet. I don't know whether to add or to exit, especially with the market, with what's going on. So I can understand the grief. I mean, but let me just say as well from the outset, what we do is we try and focus on leaders in the market. So whilst no, I'm not saying there's no opportunity in companies like this, we tend to stay away from them. Right, we want to focus on the leaders in each of these tech spaces, that, you know, whether it's Apple or Nvidia or AMD or whatever, right? And I know that might sound a little bit boring to some people, but, you know, we're here to make money and not to be excited, right? And these leaders obviously have done pretty well over the last 20, 30 years, and hopefully they'll continue to do so. But on this particular chart, so the question is, you know, is this, you know, will it continue in this space, or will it end up going somewhere else? Well, there's no really, you know, I couldn't answer that. I couldn't say, oh, you know, it's going to end up, you know, this is the beginning of the life of a firm, and in 2 years from now, it's going to be at 280, right? So if the person who's asking this is expecting an answer along those lines, then clearly that's not going to happen. But what I would say is, for whether it's a firm or whether it's I don't know, SQ or CRISPR or any of those tech names, which got absolutely hammered, because there's no difference here between a firm and SQ. Technically, they're both the same. And what I mean by that is they've got very bearish downtrends, right? So I think what I would do, and if somebody was asking me, if I had no position, I would stay away from it. If I had no position, I would stay away from it. If I had a position in here, I wouldn't be adding to it. Right, so I would either be staying put or I would be looking to exit some, right? And it's because it's in a bearish trend below, you know, it's making new all-time lows, right? So I don't know what happened before here, right? But I'm guessing it was born in February, right? So I wouldn't be looking to add to this, and what I would be looking instead to do would be to be vigilant for a potential trend change. And just like what we mentioned before on how the market could bottom, I'd be looking for that as a signal to maybe add to my positions in the future. And it's not going to be difficult. It's not, you know, whether there's a catalyst internally, whether a firm does something and the ticker turns around, or whether it's any external news, it doesn't matter. Whatever the reason is, it won't make any difference. What you want to look for is for the trend to change. And so here, what I've been thinking, and this is before I put any price points down, and you know, oftentimes what I say to the guys I work with is, it's not about price. It's about understanding price action and trends, because it doesn't really matter whether you buy at 26 or 25. If it continues in a bearish trend, what difference does it make whether you bought 2 or 3% higher or lower here? It's the same with Baba and others that, you know, that absolutely created. Your entry point doesn't make any difference if it's in a bearish trend, right? So here, what I'd be doing is, okay, so on the weekly time frame, it's clearly very bearish, and it's extended below the 9 weekly moving average, so it could bounce a little bit. And this is what I think I would be looking out for here, is the potential that a firm bounces and it does something similar to what happened a month ago. So clearly, so you've got an example of that, which is great to see. So you see a bearish trend below the 9 weekly moving average. It bounces a little bit, but not enough so that it closes above the 9 weekly moving average. What happens is it rejects the 9 MA and it continues down. So that may well happen again. And you can see over here how the 9 MA is a very good guide to potential trend changes. So you can see over here, price goes sideways for a month. And then as the 9 MA comes down, creates that convergence, that squeeze over here, there's a choice to be made. And this is what I would be looking for if I was holding this. So I'd be saying, well, the 9 MA is going to do something like this. So it's got inertia, it's going to move in a direction, something like that. So if price was to move sideways from here, then you can estimate roughly when it's going to meet the 9 MA again. And that will give you that decision point with which to look for a potential trend change or another kick in the nuts, and it ends up breaking down again, right? So this is before we look at any price levels. So that's what I'll be thinking about for something like Affirm and many other names which are having similar looking charts. Is be open to the possibility of a reversal, but don't preempt it. What you want to look for is, if it's in a bearish trend, save your money, wait for it, wait for that trend to start looking a little bit more interesting, right? If you want to average down, you could do so. But one of the things I always say is, if you want to average down, don't average down within a 3% range. So that's another big mistake that many of us make, which is, price falls 10%. And we think, well, this is a great place to add a scale. And then it falls another 4%, and we add another scale. And by the time you're finished, you've added a big fat scale within a 10% price range, but price then continues 50% lower. So if you do want to, so there's two ways to look at Affirm and many others in a downtrend. Either you wait for the trend to start to look as if it's going to improve, and the clue to that will be taking back the 9 weekly moving average, and then you'll see something like that. And bottoms take a long time to form, right? So even though you get prices bouncing around, you can see it takes time for the 9MA to flatten out. This could be 2 months. And I remember when we looked at Baba, a year ago, and I think it was at 220 or something. And I said, if you want to take a scale at 220 or 230 or whatever the price it happened to be at the time, do so. But note that it could take weeks and months for that trend to change. And then you decide whether you want to hold on to those scales or whether you want to sell and look for lower. So here, I think the key takeaways I would offer up would be, look for the trend change as a signal to possibly taking a position or adding to the position, but don't go balls deep unless you see the trend actually changing. Just holding the 9 weekly moving average doesn't signal a change in trend. It just signals the possibility of a consolidation in the bearish trend, right? So here, taking back the 9 weekly moving average opens up the possibility of a consolidation in the bearish trend, which could then either lead to a trend change going higher or a breakdown of that consolidation and going lower. So that's going to take time. And I think that's going to be the case for many of the names in the market, is to be patient. So by all means, hold that small position if you want to over here, but then just be vigilant to potential trend changes. And this is before I even put any price points down. And I think if just to finish on this, the danger that we have as traders is we look for price levels, but we ignore trends. And I think that's such an important, valuable lesson in the last 6 months is price is not important. You've got to respect the trend. And if that means you wait and you buy 5% higher, then so be it. You're not going to miss anything if it takes 2 months to bottom, right? Just like you did over here. And look left on the chart, because you often see examples of how things bottom or top in the chart. So you look left, and if you see something like this play out, then chances are a firm will do something very similar again, because these things tend to behave in the same way over and over again. So if a firm put in a bottom which lasted 4 months in 20, sorry, these are weekly chart, these are weekly candles. I'm sorry about that, but it's still quite a long. It's still 2 months though, right? So if it took 2 months to do that, then it could do 2 months over here as well. And what that does, it helps you fight the FOMO, which is a big thing, right? Because we all have FOMO. We want to buy cheap. This is really good. It's fallen 15%. I want to go balls deep here, but it takes time, and use that time to chill out, spend time with your families, and don't lose your hair trading. Because I've come across many people who have suffered a lot in the last few months. They just got burnt out because the market's taken 3 months to get to where it is, and they spent all their bullets over here or over here. And by the time we get over here, they've gone loony. They've gone bonkers, right? And I think that's a big thing as well. I mean, people have got to try and preserve that mental capital and not just the money. Because what good is it if you make $50 over here on a firm, but you've gone bananas in the meantime? It's not going to help anyone, is it? Not going to help your family, is it? So I don't know.
You got to remind yourself that you can outperform just purely due to size and timing versus price.
Yep.
You know what I'm saying?
Yep. Absolutely. It is timing. I mentioned something on stock tips a month ago. I said the bottoms you are looking for they're not about price, but they're about time.
Yeah.
And
yeah.
That throws off many people. It's about time. It's not about price. Whenever it turns, it'll be the right time. It doesn't matter what the price is. You'll still make 20%, whether you buy from here to here, or whether you buy from here to here.
Exactly.
You'll lose sleep, and you'll lose so much mental health buying this 20% instead of buying this 20%. Fuck that. Right? Wants to get that effing word in today at some point. And this is where I'd use it. This is where I'd use it. Buy to get this 20% here. Yeah.
This is so we are chartists at heart. and everything else after, right? So in the cases of IPOs, my general rule of thumb is I'll see you in a few years, right? Because I need chart evidence, I need history, I need something that says, hey, we found basing and we found stuff. There's very, very few IPOs, and I think I've mentioned this many times before. Google is the best example I can give you. Is the only one you could have bought, like that's a significant name now. That most popular. Sorry, there's other ones as well, but Google is one of the few that you could have bought from the IPO lows and never look back. Everything else bases a couple years at a max, and over the last few years, we have had some insane valuations, aka venture capitalists cashing out, running the road show, whatever you want, whatever you want to talk it. Like there's no reason Rivian should have ever IPO'd at $100 billion, right? So if you're buying in even at half the price, I think you have to understand some of that stuff too. But in general, because I keep a no IPO policy, it just leaves me from all this headache. You want to trade it, that's fine. IPOs have their early runs that go exponential. Look at Upstart, look at all of them. They all have their massive moves. Even Twitter had its massive move back in 2013 and then has done nothing, right?
Yeah, the Facebook IPO, I think, is a really good example of what you're talking about. Like Facebook pretty much based like a year and a half, almost 2 years, I think, if I remember right. I mean, it broke out about the same time you're talking about Twitter, about that 2013 time. It's just, yeah, you've got history.
Yeah. But you'll normally see in my experience, and Cookie, you can talk about this, Nick, you can talk about, and normally you'll see there's like a massive volume spike at some point, right? Like on the downside. And that's usually going to be closer to the end, not the end, but it's going to kind of wane down in momentum on where in that basing kind of cycle happens. It might be 1 week, it might be 10 weeks, it might be 12 weeks. But I think that's like, if you want to be an IPO in a company that you really believe in long term, wait for the base to form and look for that volume kind of capitulation spike to the downside, and then see how price action reacts from that. But let it form the base. There's very few stocks that you buy today and are up 10,000% next year, right? So you're not gonna, if your general trajectory is that this is one of the ones that you want to hold long term, and you're looking for, a 10x, 20x over the next 10 years, who cares about what the price is down here? Just wait for it to base, right? Whether you bought at 40 or you buy at 100, if it's at 1,000, does it really matter for $60? That's just been my view on IPOs, and I generally avoid IPOs. And then when it came to SPACs, I was like, no, thank you. Like everything smelled so bad with SPACs. I was trading it, don't get me wrong, but I have no desire to trade SPACs because there's just too much uncertainty, and it looked like a big cash grab. And if it looks like a big cash grab, then it's probably
all right. As we're winding down, we're getting hit with questions, as would be the case. And Cookie, I just want to be cognizant of your time. I know you're halfway around the world, so I don't want to keep you much longer than the hour that we promised. But I do want to get to these. Net Zero Trader asks, I understand the overall bullishness based on simple moving averages direction, but the current market environment is highly inflated with extreme level on retail money flow. For example, some of the SPACs and the IPOs went up 10x and are now coming back down to earth. It has an influence on it has an influence on the indices performance. Do you still believe that the moving average direction theory for bull bear still holds true?
Yes. I mean, that is because what leads to price, the causes are irrelevant. And this is the typical phrase that any technical analyst, technical trader will use. It says, I don't care about the causes. I'm just interested in the effects on price. So if price is showing an uptrend, it's an uptrend. Whatever caused that, it doesn't make any difference whether it's the SPACs in the system or whether it's the high valuations or low valuations or Tesla being included in the index or not being included, whether it's Google with splits or whether it's Amazon with split. It makes no difference. If the trend is up, it's up. It doesn't make any difference what caused that. right? And I think, you know, one of the
Well,
things
there's only one cause, right? I mean, there's only one cause. There's more people buying than selling.
Yeah, possibly. Yeah,
Or
I agree. Right. There's upward pressure, and that's it. That's the only thing that matters. It's the only thing that counts. And people need to, I think, try and dumb down the decision-making process into as fewer variables as possible. The fewer variables that you take into account into making that decision, the easier it's going to be to make that decision. And trust me, making the right decision based on just one or two variables, which is what ultimately what drives the trade, which is a bullish trend or a bearish trend, nothing else matters. What I would say is give it a go. That would be the best thing for me to say, right? So rather than taking my word for it, have a go, try it, right? So just look at the moving averages and look at nothing else and see how it helps you. If it helps you, and which it should, then that will be you being, that will convince you rather than me having to explain it.
Our friend Zach has, and we kind of went over this briefly, but can VIX-ageddon with a SPY of 390 still result in a continuation of the longer bull market? And Zach, I know you joined late, but if Cookie would pull up his ES chart again, I believe 390 would result in the 20 rolling over, the 20 monthly moving rolling over. So that would probably not be positive, but I'll let Cookie hit you off with that answer to be precise.
Are we talking about the monthly chart?
Well, yeah, he's just asking if if SPY can go 390, would that still result in a continuation of the longer bull market?
Okay, good. It's a great question because it allows me to expand on a point which is important, and it comes down to time again. So it's not just about the level that price goes to, but it's how long it stays there. Because trend is not about price, trend is about time. Or at least it's as much about time as it is about price. So I mean, let's ask that question. Let's imagine that we're in 2020, right? So you see that massive spike down, which lasted, these are monthly candles, right? So during 2 months, price has created 35% over the course of those 2 months. But because price didn't stay down there for long enough, the moving averages weren't impacted. And that's the key here. So price could go down to 390, 380, 370, 360. It makes no fucking difference. What makes the difference is how long it stays down there for. And that's what will decide whether we get a bear market or whether it's just a pullback or a corrective move in the bull market. It's for how long it stays down there. And this is, again, goes down to that point about how time is so important that people just don't underestimate, that people just underestimate this idea of time, is that it will affect the trend. So here, I mean, so basically the point I'm trying to make, let me just add a picture here, right? So if we get a move like that, and it goes down to 3,800, even 3,800 or 3,850, 390, which is the point, which is the question that he asked. If we go down here and we do something similar to this, and we head back higher again, then clearly 390 wasn't the issue. It's how much time we spent down here that made that difference. But if we go down to 390 and spend the next 4 months there, then the moving averages are going to roll over and the trend will change. So you've got to take both of those factors into account. Hopefully that makes sense.
A couple charts real quick, Cookie, if you have time. AVLR is one.
Okay.
From our friend Seth.
Seth, are you trading? Are you asking Cookie to trade your account? He was saying yesterday he wanted to trade himself or someone else.
Okay, now let's take a look. So this is the monthly chart for AVLR, right? So I mean, start off with a very fair assessment of what you see as far as the trends are concerned. So you see the 9 monthly moving average has rolled over. You've seen the 20 monthly moving average has rolled over as well. And this goes back to what I mentioned earlier with the ES chart, right? It's time has spent long enough below the moving averages on the monthly time frame, right, that the trends have turned bearish. So that's not a good look, right? Clearly, that's not a good look. So here, what I'd be thinking is what you could see in something like AVLR, right, is that, you know, I'm not discounting bounces, and what you're likely to see are strong bounces here in this area over here that could retest the 9 monthly moving average, right, as it comes down. So what you're likely to see is something like this, right? So you've got the 9 monthly moving average like that. So let's just extend and the good thing about using a monthly chart to begin with is the moving averages will tend to follow the same sort of trajectory. They won't change in a week, right? They'll remain sort of like that for a couple of months, right? But that would be my starting point of imagining what the 9MA is going to look like. So what you're likely to see is, so let's say there's a catalyst like the Fed this week, and let's say it impacts the whole market, including AVLR. What could happen next, right? So what's likely to happen is if the market bounces and everything does, let's say everything in the market bounces because of what the Fed does, then what you could see is that you can see AVLR retracing some of this candle, and it will consolidate in this area until price reaches the moving average, right? So whether it goes all the way back up to there, which, I mean, I'm not ruling it out, but it's unlikely, right? Whether it goes all the way back to test the 9 monthly moving average on a move down from here is one possibility, but unlikely. But what's more likely is it ends up filling this space over here, right? And the way to be able to forecast that is in the following way, right? And this is a tip that you can all use, right? It's, in a bearish trend, you'll tend to, and in a bullish trend as well, right? So in a bearish trend, you'll tend to see the previous monthly high acting as strong resistance, right? So you can see lower monthly high, lower monthly high, lower monthly high, right? So what you'd be looking for a priori is for prices, or for price over the coming months to fall below or to find resistance around the previous monthly high. Now that, so without having drawn a chart, there's already a pivot there. And that's what I often say. So, without having to draw fancy channels, there's a pivot there at 106. So we know that in the month of April, 106 will exert some sort of resistance, whether we get that close or whether we fall short. So that would be my first thing that I'd be looking for. And then if we do find resistance, like you see lower monthly highs every month since we broke down, then you want to be looking for this space to fill out, so long as we hold the lows on this month. So let's assume we hold the low of this month, and that's how you get pennants forming. Well, that's the reason why pennants form the way they do, or consolidations, whether in bullish trends or bearish trends. You'll end up with this space like that. And then what will decide for AVLR whether it goes sideways or whether it continues down is it what it does with the 9 monthly moving average as it rolls down in the next 3 months or 4 months. It might take, depending on how price does over here, right? And then you can forecast that when that's going to happen. So by the summer, right? So assuming we go sideways from here, let's assume there's some great catalyst from the Fed and he's not going to raise rates as much as everybody fears, right? And the market goes sideways over here, then you want to see the monthly lows hold this month and then to fill in this space over here. And that becomes a straightforward trading range for the next 3 months without any trend lines, without any channels, without any bias at all. And all you've done is looked at the probable path that the 9MA takes and how prices could consolidate below that. And then ideally what you want to see is for price to break across the 9MA and then to bottom, maybe something like that. And again, as I say, these things tend to exhibit the same sort of behavior they've done in the past. So in the case of AVLR, it could do something like this as it bottoms. It's done it before, so why wouldn't it do it again? And you can see, if I just clone that, you can see that it's done it time and time again. So this sort of range has been repeated, right? And stocks do that. One of the things that I focus on a bit as well is this idea of repeating volatility, right? In uptrends and downtrends, right? So this would be the sort of area that we possibly could see over the next X number of months. I mean, over here, it went sideways for 5 months. Over here, it did the same. So it could do the same again, especially after such a strong move down. My starting point would be this. Assuming it holds this low, then the next 5 months could look like this. And I think this is what helped us avoid the mayhem in BABA, because early on, I suggested that based on what we've seen in the past with BABA price action after its IPO, that it may take 4 or 5 months to bottom. This is when the bottom first fell out. So this was around 200 or something, 250 or something. And that made some of us just stay away from it. So it wasn't about FOMOing in on the dip in BABA at 240, but it was about understanding that dip may not lead to a reversal for 4 months. So when you start factoring this idea of time and how long consolidations can last in trends, then you start thinking, well, do I really want to tie my money up here? Or do I want to be in tickers which have a trend in the direction that I want to trade? So allocate my capital in trending markets. Now, if you want to trade short, then this is fine. There's nothing wrong with that. This is perfect. Again, you're looking for easy. You're not looking for change. So I would pray that the downtrend continues and AVLR goes down to 0. Why not? Why the fuck not? Right? I just want an easy trade. So this is an easy downtrend. There was an easy uptrend. And I think one of the things that, as traders, we struggle with is this idea of remaining completely unbiased and just trading the trend, whether it's up or down, just respect the moving averages and just go with it. Just absolutely go with it. And it requires a lot of rewiring. I see many people struggle with that. It's very simple on paper, but it's very difficult to put into practice because we let all of our biases get in the way. But that's what we've got to try and do. Keep the analysis simple, focus on the execution. That's another one of the things I say a lot. Keep it as simple
Last one, Cookie, Airbnb, ABNB, and Net Zero had a follow-up to your MAs. So when it comes to your long-term positions, do you hold on to it until the MA turns over?
I'll scale in and out. So that, it's a good point to make. So I will not hold the same position all the way up and all the way down. Right? So I will scale in and out. In other words, what I'm doing is I'm taking advantage of the volatility in the trend to sell some at resistance and to buy back at support around a core holding. Right. So in other words, what I'm doing is I'm not just buy and hold. What I'm doing is I'm looking to add to that position by trading the volatility en route. I mean, here as an example, let's imagine that we're in 2000 and, when, in the happy days when AVLR was making everybody happy and everybody was shit posting on stock tweets, for example. Right. So even during that period, even during this period over here, look at the volatility in these candles. I mean, you're looking at 10% moves, hold on, what am I talking about? 30%, effing hell, 30% on each of these 3 monthly candles. So this is the thing. So what I try and do is take advantage of volatility in the trend, whether it's an uptrend or a downtrend. And I think that's where, my discipline comes in. It's like, I respect the trend, but I'm still going to try and trade it based on the volatility we see. And you can draw down the channels, optimal entry points and exit points, but trading around the core position. And tickers like Tesla, AMD, all the others, all those fave stocks, they have a great deal of volatility in trends. So whilst they're even trending higher, they will have 20% ranges. When they're trending down, they'll have 20, 25% ranges. And I think, it's a very important point that we should make. It's not black and white. It's just a world of grays. Even in a trend, you see ranges like this. And I think that's the opportunity. I mean,
I think scaling in and scaling out, I think people may understand that a bit better than trading around a position. And the way I do it when I'm trading around a position, what I do is, when I buy onto a core, let's just say AMD, right? AMD is one of my core positions and I trade in and out of that. And what I mean by that is when I buy, right, I'm buying higher than my cost basis. But when I sell some, it's that higher priced chunk of the buy, right? So I bought AMD at 105. When I decide to trim some of that out, I'm selling those 105s and not the lower cost basis.
Mm-hmm. Okay.
So Airbnb was the next one. And then finally, Randy says, doesn't time ultimately deteriorate the trend if it goes on too long?
Yes, it does. That's what I mentioned earlier with the ES chart. Yep. And then use this as an example of what could go wrong. So this is what could go wrong with ES if it stays at 3,800 for too long, right? If it goes down to 3, this is how you'll see the trend deteriorate. This is a good point. Let me make this point as well. So let's imagine this is the S&P, right? So let's imagine that this is the S&P. So it made this high in October, and then it went a little bit higher in January, and then it absolutely tanked, right? So now we're here around the 20 monthly moving average. So let's go forward in time and imagine we're in April. And let's say March closes like this. So we're still, 15th of March. Let's imagine that this is the S&P and we close somewhere over here. Then what we want to look for in the month of April is, do these monthly moving averages become resistance or not? Because if they do, then what they're telling you is that the possibility that this trend could begin to change. Because remember, the only thing that will impact the trend is whether we hold the moving average above the moving average or not. if we're finding resistance at the moving average or below the moving average, then that's going to pull the moving average over, which does deteriorate the trend. So you'll see that play out, and you'll see how accurate the moving averages are themselves in being pivots. So there's no trend line here, but we went to 156, which is where the 9 monthly moving average is. Right, and you can see here, there are no trend lines here, but these moving averages act as natural pivots in the trend, whether it's an uptrend or whether it's a downtrend. Buy the moving averages on the way up, sell the moving averages on the way down. If we stay long enough, then you will see that trend deteriorate.
I dig it.
And finally, Zach wants Airbnb, and here we go, Zach.
What a mess, isn't it? I mean,
hey, GP, can you shit talk Airbnb for like 2 seconds?
Yeah. Zach, how's that position doing so far, huh?
That's Airbnb.
Yeah. This is one of those, hey, I'm going to buy this IPO. It's going to be great. Oh, look, it formed a 2-year base. Oh, cool. That's exactly what you want to see, right? So, people are talking about the price action in Airbnb has been atrocious basically since the first pop in early 2021, and it's basing, which is great, but there's no direction at this point.
I'll buy it at
you might be right to what 15 years from now, when it actually catches up to its valuation, just like Rivian.
Hate.
You asked me to. Anyway.
No, I'm not complaining. Zach's the one who wanted to be flogged in the public square. So there you go. Or sorry, hey, Zach was the one who wanted to be flogged.
I can add something on the Airbnb and what to look for. I mean, I think.
Yeah, please.
I think it's a good exercise we will execute better as traders if we plan better. Right, and I think that's very clear. And sometimes the planning doesn't need to be complicated, right? So everybody has all these screeners and watch lists and all these things, but here what you see is, as I mentioned before, we've got a falling 9 weekly moving average. So this is the weekly time frame, by the way, right? You've got the falling 9 weekly moving average. You've got a 20 MA which is rolling over. So it doesn't look that different to this period over here. So again, like I mentioned before, what I tend to do is I will look left on the chart and find a similar looking trend or similar looking place in the trend in the past to see whether it offers up any clues to what might come next. But ultimately what I'm looking for here is this. I want to see price get above the 9 weekly moving average, right? And then for it to hold above that 9 weekly moving average. So then that forms the bottom that ends up going higher, not unlike this. Now, what this tells me, though, is when I look left on the chart, what it tells me is even if we take the 9 weekly moving average and we find resistance at the 20 weekly moving average, then this bottom took weeks to play out. So even though it ultimately went higher, notice when it did was when the 20 and the 9 MA converged. So typically you will see that. So whilst you see prices bottoming and holding either side of a weekly moving average, for example, right? Then what you'll tend to see is the convergence of moving averages, which put an end to the consolidation, right? So over here, you see that. And even over here, can you see, you see the beginning of the 20 MA, just over here, you see the falling 9 MA, and this put an end to this period of chop. So there was 3 months of prices going sideways, and then prices broke down as price found resistance at the 9 and then continued down at this convergence. So, and over here, you see prices going sideways for 2 months. But when the moving averages come together, that signals, that means I need to be prepared for the possibility of an uptrend beginning here. Right, so you can plan for that. So given that's what we're looking for, what would that look like in the future? Well, clearly we're still below the 9 MA. So there's no rush here. There's absolutely zero FOMO of missing out on Airbnb's uptrend. It's not going to happen. You're not going to wake up and it's going to be at $200. It's not going to happen, right? So what you'd be looking for here is, okay, I'll keep this on my watch list because I love the company for whatever reason, right? But a priori, I'm not interested in. I mean, you could, if you're holding a position, then I would say, well, buy near the bottom of the range, which is fine. Hopefully it holds the bottom of the range, hold a position here. But I would only start getting excited if it starts holding the 9 weekly moving average. And then what I'll be looking for is the possibility that the 9 and the 20 converge in this area over here, which could signal the end of this future period of chop. So what I'm looking to do here is to try and forecast a period of chop based around price playing ping pong around the moving averages. When those moving averages come together, hopefully because we've held this support, right? So we hold this support to begin with, price gets above the 9 weekly moving average, those two come together, and then we get something that looks like that, right? And then maybe that takes us to the top of the range, right? Something like this, because that's all it's done. It's just gone sideways. But many things start off like that. AMD looked like that in 2000 and what was it, 2013 or something. It went nowhere. It had fallen from God knows how high, and it went nowhere for years. And then you started seeing this play out. And then you weren't late, even if you didn't buy the absolute bottom in AMD in 2000 and what was it, 13, 14, something like that. And you did this, you let it play out. You still would have been on time in the uptrend that followed, and it lasted years. So I think, again, it comes down to, being patient, not having FOMO, have a position if you want to, if you love the company, but only get excited when you start seeing the trends change. And it will be black and white. There will be no ambiguity. You'll see the moving averages go higher. You might see volatility in that move higher, but you'll see the moving averages point higher. And that will be your cue to either add to the position or start shit posting like crazy on stock picks like we do. Right?
I've got a bottom fishing pattern on ABNB if you want the. Can I share my chart real quick, Bags?
Sure. Cookie's got to stop sharing.
Yep, I'll do that.
And we're going to wrap it up with this one, guys.
Okay.
I know we've been on a lot longer than we expected, but Cookie, we greatly appreciate your time. Nick, GP, of course, appreciate you guys jumping on too.
Yeah, absolutely.
No worries. Educational.
So from a price standpoint, you guys know that I kind of look at the way price moves, I think, a little bit differently than some people. I try to find, I can't remember where I read it, but price typically moves in symmetrical fashion. So ABNB has a golden number, a golden ratio of like roughly 40 or 50 points. And what that golden number is, to me, is the distance in which price will move before pausing. And the way that I came up with that is basically just looking at A, B, and B as this range here, right? You can just draw a line from high to kind of where price paused here. And then as price continued, it basically completed the ABCD leg up in the losing my words here, but price is moving in the same symmetrical fashion as it completes the CD leg as it did when it created the A to B leg. Price, even if you're looking over here or over here, it's breaking about 40 points, pausing, breaking another 40 points. So the other day I tweeted something about using ABCD patterns to buy a pull-in, because you can play an ABCD pattern alongside the short side, but if the longer term trend is up and we're seeing an ABCD pattern down, it's a way that I can find where I think a bottom might occur. And if that bottom occurs and it coincides with a major level of support, a major moving average, there are more layers stacking that edge again in my favor. So looking at this ABNB here, I'm kind of ignoring this wick. And the reason I think it's heading to 100 to 110 is just because you have this longer leg down, AB, the C is here, and the measured move is like basically right down here, D. And so like, why would we get a move down to 100? Okay, well, like, let's say the indexes decide to puke and that 300, 400 get taken out and we decide to leg down. Okay, we get that leg down. That's where I would see ABNB heading along in the same. You also have the round number of 100 right there too. There's another reason that I'm kind of thinking it's heading that direction. It pukes lower and then it kind of bounces back into the range. What you would be looking to do is having your starter position either 100 or 110, 105, whatever. You want to see price rally back up to this 130, 120, 130 area. You want to see it hold and then close back above this and climb back in this range. Then maybe start legging in and then waiting for it to get back up here before it breaks out to highs. But if this was any other stock out there, and price is kind of moving from the lower left to the upper right, and this pattern is coming down this direction while the moving average is starting to kind of curl up this way, it's where I think exhaustion is going to be reached, as price kind of moves down. But just kind of I'm not playing ABNB. It's just a kind of a thought that I had.